What exactly is value investing? Value investing is a type of investing that focuses on stocks that are undervalued by investors in the market as a whole. Stocks that value investors seek typically appear cheap in comparison to their underlying revenue and earnings. Investors who employ the value investing strategy anticipate that the stock price will rise as more people recognize the true intrinsic value of the company's core business. The greater the gap between intrinsic value and current stock price, the greater the margin of safety for value investors seeking investment opportunities. Because not every value stock will successfully turn its business around, that margin of safety is critical for value investors to limit their losses when they are wrong about a company. What characteristics distinguish a great value stock? A value stock is distinguished by its low valuation in relation to the market value of its assets, or key financial metrics such as revenue, earnings, or cash flow. However, the best value stocks have additional attractive characteristics that make them appealing to value investors. Businesses that have a long track record of success, profitability that is consistent, stable revenue streams with no significant growth, but also no significant sales contractions, dividend payments, though they are not required to qualify as a value stock. However, it is critical to recognize that a company with all of these characteristics may not necessarily be a great value stock. When a stock appears to be a good value for investors, it may actually be a value trap. Even when their stocks appear to be appealing, value traps can continue to experience share price declines. Why should you buy value stocks? Everyone enjoys a good deal. And because value investing seeks stocks that are selling at a discount to their intrinsic value, the investment strategy is appealing to those who enjoy getting a good deal. All it takes for a value stock to make money is for enough other investors to recognize that there is a mismatch between the stock's current price and its true value. When this occurs, the share price should rise to reflect the increased intrinsic value. Those who purchased at a discount will then profit. Furthermore, many investors prefer the margin of safety provided by a stock purchased for less than its intrinsic value. There is no guarantee that the stock price will not fall further, but it makes further share price declines less likely and less dramatic. A good value stock can provide both protection against losing money and the potential to cash in once the stock market recognizes the stock's true value for those who consider themselves defensive investors with a low risk tolerance. Patience is required when investing in value stocks because it often takes a long time for a value stock to be repriced at a more appropriate and higher level. However, for those willing to wait, the rewards can be quite substantial. How to identify value stocks? Value investing necessitates extensive research. You'll need to do your research by examining a large number of out-of-favor stocks in order to calculate a company's intrinsic value and compare it to its current stock price. You may have to look at dozens of companies before finding a single one that is a true value stock. Many would-be value investors are put off by this, but there are some tricks you can use to identify good value stocks. You can swiftly eliminate unsuitable stocks to focus on your top choices if you have a thorough understanding of the various methods used to value a company and evaluate its business prospects. By fully understanding the various methods for valuing a company and assessing its business prospects, you can quickly eliminate ineffective stocks and focus on your best candidates. Avoiding value pitfalls. A value trap is a stock that appears to be cheap but is not. A couple of situations frequently produce value traps that value investors should be aware of. Earnings in cyclical industries such as manufacturing and construction frequently rise significantly during boom times, only to disappear when industry conditions cool. When investors expect a stock to go bust, its valuation will appear very cheap in comparison to recent earnings, but much less so once earnings fall during the weaker part of the business cycle. Stocks that focus on intellectual property are prone to becoming value traps. For example, if a drug company has a popular treatment but is about to lose patent protection for it, a large portion of its profits could vanish quickly. The same is true for a tech company that is the first to market in a new industry but lacks the ability to compete. To avoid value traps, remember that when valuing a stock, the future of a company is more important than its past. Focusing on a company's prospects for future sales and earnings growth will increase your chances of finding true value stocks. Allow value investing to assist you. The most important thing to realize is that value investing necessitates a long-term outlook. The market can remain irrational longer than you can remain solvent. Economist John Maynard Keynes once said, "The lesson is that, while timing can be lucky, and an investment can pay off quickly, even a value-focused strategy cannot guarantee quick gains." Mr. Market does not always realize quickly that it was incorrect about a stock or undervalued an asset. It takes time to implement value investing strategies, but the time and effort you put in are well worth it. Understanding and applying the value investing concepts Graham discussed nearly 90 years ago and that Buffett and others have added to and improved upon since will make you a better investor with a better chance of selecting great stocks.